Well, markets are bracing for a week full of inflation data ahead of next week's Fed decision. A September cut is just about fully priced in. Our next guest says the Fed should not only cut this month, but 2 more times this year. That could trigger more gains for the market. Joining us now is Anastasia Amoroso. She's the chief investment strategist for private wealth at Partners Group. Anastasia, you think next week's Fed rate cut is in the bag because of labor market weakness. I'd also like to point out the New York Fed's survey today that showed the lowest ever confidence from workers they could find another job if they lose this one. Does that outweigh any potentially bad inflation numbers this week?
I think it does. I think it does, because inflation in a way is backwards looking. And when you think about what a consumer is likely to do if they don't have the confidence in whether they have a job or not, they're going to pull back. So whatever inflationary pressure we may see that happened last month, if the labor market is not there, you can't pass through those cost increases. You don't have any pricing power. So that's why I think the Fed, rightfully so, is really prioritizing the labor market. John, and you mentioned one data point. We can cite so many more that tell us that the labor market weakness is really sort of becoming pervasive. You know, we saw it in payrolls report. We saw it in the breadth or the lack of breadth in terms of job creation. We see that people look at the number of job openings, and there are now fewer job openings than the people unemployed. So it's really sort of everywhere. So that's why I think it's so critical for the Fed to deliver not just one rate cut, but several, because 25 basis points is not going to put a floor under this labor market. 75 or 100, that's another story.
Well, what about that arguably deflationary scenario where consumer demand slacks off quickly heading into Q4, though? Wholesale prices paid still high from tariffs. Retailers have to sacrifice profit margins and discount. Why is that good for stocks heading into 26?
Right. I mean, I do think if the Fed is successful at sort of putting a floor under this economy, and you still have corporate earnings that are coming off really robust levels. We just had, I think, third or fourth consecutive double-digit earnings growth for corporations. You know, and actually profit margins have not pulled back all that much. So I think corporates are able to maybe shift the supply chains, pass through some of the increases. They're able to sort of maneuver. And so if on top of that you preserve the consumer by ensuring that the rate cuts in the market, I think all of that puts us into a positive space for year end.
So just to go back to what Rick Santelli was saying, especially with some of the data we're getting later this week, do you think near term sub 4% on the 10-year Treasury possible?
Yes, if the economy continues to weaken, right? I mean, there's really two things that the market really worried about. The first, they worried about the fiscal debt and the unsustainability of the debt. But what the market has really come to realize is the tariff revenue, which is, hundreds of billions of dollars that we're likely to collect in tariff revenue, that's really an offset to the increase in budget deficit that we've seen, for example, from the tax bill. So that's the one thing that's sort of helping keep the lid on a 10-year Treasury. The other one, a couple of weeks ago, maybe even last week, the market's worried about Fed independence. But even there, I will say that maybe there's executive pressure that's going to continue to be put on the Fed, but there are also checks and balances. And just because a president may say he wants to remove somebody, it doesn't mean it's a done deal that day. There is a court process, and that takes time to play out. So I think the checks and balances prevails, and that sort of prevents from sacrificing the Fed independence. So the market seems to have come around to that, and that's why you see the 10-year pullback. And then, Morgan, to your point, if the labor market weakness continues to weaken, and if the economy is sort of in this in-between space where you see the slowdown from tariffs, and we don't have the tax cuts kick in yet, because that's going to happen in 2026, that soft spot, that's where we drive the yields lower.
Goldman out today saying small caps are going to play catch up here. Do you buy there? Do you buy somewhere else, especially if you think the Fed is going to start cutting and cutting on a regular basis? Yeah, look, of course, it makes sense that small caps would be the trade that is most levered to rate cuts, because they do have quite a lot of floating rate leverage. And of course, that makes sense. But it's not the highest quality trade. And so that's why, as private market investors, for example, we do look to middle market companies, but private equity backed. If you look at the small cap index, about 46% of that index today is about unprofitable companies. And that's up from about 27% some years ago. So that's why it is not the preferred trade. But if you are looking for a trade that's levered to rate cuts, it certainly would be one.